Hey everybody, welcome to this free edition of our Trader User Group, a weekly roundup. This is for the trading week ending August 28th, 2020. August is coming to an end. Hey everybody, I'm Preston Brent. Thanks for tuning in. Remember, don't be a rat brain trader. You want to be the red striped zebra. Stand out from the herd. This week's theme is up, up, and away. And clearly that's kind of what we're seeing in the equity markets. Let's kind of take a look at just a market summary real quick on this graph that I got set up here for you, or for the spreadsheet. As you can see, the U.S. index performance, just about everyone is in the green year to date, with the exception of the Russell. It's down 5.4%. And if you look on the right-hand side, you'll see U.S. valuations and volatility, the PE ratio, the trailing 12-month PE ratio is at 36.19. Forward 12-month is at 26.74. So the forward PE is, even though it's lower by 26.11%, it's still very elevated. Remember, the couple of decade average is around 15, 16. So we've got a very, very elevated PE ratio. The dividend yield is 1.75% for the S&P. The 10-year Treasury yield ended this past Friday at 72.9 basis points. So the spread between the two is 1.15%. So it still encourages money into the equity markets, just the spread between the 10-year yield and the dividend yield. Current VIX actually went up for the week. It was up about 1.87%. So it closed out the week at 22.96. Same thing as last week. Now, I will tell you guys that when the VIX and the S&P are positively correlated, generally the VIX wins out, which means we should expect a little bit of a dip. I'm not expecting a big one. I'll show you the charts here in a minute. If we look at the sector performance for the week in the U.S., you can see the best was technology, up 4.63. The worst was utilities. It was down 0.61. And then the annual sector performance, you can see technology is just kicking butt, up annually 43.75%. The energy is coming in at the bottom at 34.36%. Now, if we look at the world index, you'll see just about every world market is underwater for the year. With the FTSE, it's still in official bear market territory. That's London. The only one that's in the green year to date is China. The Shanghai index, it's up 11.6%. So if you look at the best performers globally for the larger economies around the world, besides China, it's really the only actions in the U.S. You got the Dow, which just went into the green year to date, 40 basis points. The S&P and NASDAQ. NASDAQ is kicking butt. It's up 30.35% for the year. This past week, everything was in the green for the U.S. markets. And then the world index, kind of half and half. China, the DAX, which is the German index, and the CAC 40, which is French. The French, it wasn't up 12%, it was up 2.18%. But generally, the U.S. is kind of where the money is right now, and still, okay? Now, if we come over and just take a look at the sound bites for the week and just kind of see what's going on, let's start with the market rally. First, it's just been on fire. We finished the week higher. It's on track for the best August, the U.S. markets, in 34 years. Really just going really crazy. And as I said last Sunday, the S&P is up a little over 52% from the bear market bottom that was made on March 23rd. And it's just really having a very strong rebound. The S&P was up over 3,500. It broached 3,500 for the first time this week. And as I said, the Dow moved into the green year to date. So we're seeing signs of strength there as well in some small cap. And if we look at the real-time forecast from the Feds out of Atlanta, it shows that the estimated Q3 GDP is going to be up 26.1% for Q3. And that's following a 32% annualized decline in Q2. So again, when you shut everything down, you get this wildness here. And if this does prove to be the case, then by the end of September, the economy would have recovered half of the pandemic-induced losses, leaving the real GDP about 5% below its pre-crisis levels. So still a lot of ground to cover, but all in all, really a great first step. Now, if we look at the housing market's on fire. It's a very notable area of strength within the markets. Both new and existing home purchases are exceeding pre-pandemic levels. In fact, we're having the best level since 2006, and that's all with lumber prices through the roof. Okay. But we got a strong rise through from last year too. Consumers are also redirecting some of the spending from travel and leisure and other services to durable goods and other hard goods. So that's driving July retails up over 1% higher from January. So retail sales is good. In addition, we're getting industrial production has improved for 3 months in a row. Still below the 8%, 8% below the pandemic, but still um, forward-looking surveys still look good. So that's one of the reasons why the markets are going up. Okay, as they are. If we took a look at unemployment, it's a little bit uneven there. We still got high unemployment, almost 6 months after a record 6.9 million Americans filed for unemployment in March. You know, the initial jobless claims continue to run over a million over the past couple of weeks, which, by the way, is higher than any time during the great financial crisis of 2008. But again, we shut everything down. You got to remember that, guys. We've shut everything down. This is 2020 is going to be a year for the ages. We'll look back on this and remember this. It's almost like a 1929 kind of thing. So the initial rapid improvement in unemployment was kind of facilitated, as you guys know, by this uh, um, just a huge stimulus that's been moving into the market. Just really, really, and all these furloughed workers are coming back too. But we've got still large segments of the economy remains very much constrained, and some of these temporary layoffs are going to turn to permanent layoffs if these businesses aren't allowed to reopen soon. So that is going to pose a threat to future consumer confidence in the trajectory of the markets, I believe. Now, one thing that's also dramatic this past week is the change in the U.S. Fed policy. So that is just, and it can't go unnoticed. Okay, Fed Chair Boom Boom Power Ranger Powell. He announced a shift in the Fed's approach to achieving their long-term inflation targets. We've been under that since 2008. But what they basically said is the Feds are going to allow inflation to run moderately above its 2% goal. Okay. And the Feds also revised its policy stance around changes in employment, suggesting, based on these changes, that the central bank is going to continue to provide accommodation to the markets. Even if unemployment starts to come down, they're still going to maintain this accommodation. So that is a big, big change in market philosophy for the Feds, and that's also helped goose the markets higher. Okay, so just keep that in mind. The other thing, which is kind of lost or escaped notice from a lot of folks, is the Q2 earnings are coming to an end. 98% of the companies have reported second quarter results much stronger than expected. In fact, they set records because everybody was overly pessimistic. We've seen improving economic data, but of course, very low hurdle rates. So it's very easy to step over the bar with this earnings season. Valuations, as I said earlier, are the forward PE ratio is 26.74. So we got very high valuations, but you know that basically reflects the super ultra low, record low interest rates and the Fed commitment to keep them low for quite some time. All right. So that will dramatically influence how investors are going to be, how much they're willing to pay for future earnings. With rates low, they're willing to pay more for future earnings because it's still a better bet than putting your money or parking it somewhere where it's not earning anything. Okay. So, but this does mean though that future equity returns are going to be greatly dependent on earnings growth. And if that earnings growth isn't there, then watch out. You know, we're gonna see the markets fall a pretty good little bit. Okay. And then finally, there's going to be a big change in the stocks that make up the Dow. Okay, and this is the biggest adjustments to the index since 2013. The S&P Dow, right? The Dow indices announced this past week that Salesforce.com, MGN, and Honeywell are going to come in and replace, say it ain't so, but Exxon, Pfizer, and Raytheon. I mean, just these stocks are coming in and these three are going out. Okay. The addition of Salesforce and the removal of Exxon, which, by the way, was the most valuable U.S. publicly traded company as recently as 2014. So about 6 years ago, that was the most valuable company, and now they're getting kicked out of the Dow. Totally amazing. Amazing. And this was triggered by Apple's 4-for-1 stock split. Okay. Remember, that's going to take effect on August 31st. It's coming up here, guys, as in Monday. All right. August 31st, we're going to get the Apple stock split and the Tesla 5-to-1 stock split. So since the Dow is price weighted index instead of market cap, like the S&P, basically stocks with higher share prices, not necessarily larger market cap, gets a bigger weighting in the Dow. Okay, so the Dow, they do their weighting differently. So when Apple goes 4-to-1, that's going to change the makeup of the Dow. Had the committee not made this swap, the Dow technology weight would have been almost 8% lower than the S&P 500. So therefore, that swap is going to have the tendency to close that gap and make the Dow more reflective of the current state of the U.S. economy, which is really more consumer and technology oriented than industrial based, which is what the Dow used to be. So these are some of the reasons why we're going to see Amgen, Honeywell, and Salesforce come in. I mean, Salesforce and the Dow, it's amazing. Coming out, Exxon, Pfizer, and Raytheon. So just really some big dramatic changes in the Dow that are happening. It's going to be on September 1, obviously at the end of August when this stuff goes down. Now, I'm going to switch you over to some charts and just show you a couple of really quick things here. So let me just get you over here to the S&P 500 E-mini futures. I'm going to get that. Let me just get that going here for you guys. And once that comes up, I'll wait for it to paint the screen so that you can see it. Now, what you should see is a big colored bar up here. This was my target that I put in back in July. The target was around 36.42. I had an initial target back in early June of 33.10. Okay, we took that out back on August the 5th. This smaller colored bar was generated on a daily time frame. This bigger one is generated on a weekly, which is why it's a little bit bigger in size and scale and scope than this earlier one here. Now these bars are generated with a combination of Gann and Fibonacci extensions off prior pivot highs and lows. It's easier for me. I could do Gann and Fibonacci on the charts, but I don't want to just looking like a spider web here with a lot of lines going through it. So I just use this tool, which really makes it pretty good. And you can see here the target. In fact, I've told our members I can see it running up to 36.50. And once we got over 33.10, we were off and Katie barred the door. We took 3,400 out very quick. And then this Friday, we took out 35.09. And guys, I know what everybody's thinking. Everybody's thinking, including you can't listen to anybody on TV without someone saying, hey, the markets are due for a big crash. We're stretched. And it's just like on every TV channel. Okay. Keep in mind the markets can go higher for longer than you think. Now, we've been playing it bullish since early April in our group. I've had everybody going long, and we've been playing some of these dips, and they haven't been very big. The biggest dip we had was back on June 6th or June 8th, June 9th time frame. And we came right down to my target. Now, my initial target here on this dip that I see coming up over the next couple of weeks is going to take us down to around and can take us down to around 3,400. If 3,400 does not hold, we're going to come down to the 33.50 area, which is where you can see this line here. Off on the left-hand side of the screen, you can see volume over price, and you can see these dips here, which is more like a black hole space, right? You got a dip here, you got a dip here, you got a dip here, and then just a couple of small dips here. But you can see right here is where all the volume is sitting. And there was a lot of buyers at that volume right there, right on this pivot point right there of 33.57. So that would be my natural inclination if we get any little pullback. You can see I've got, again, automated generated pullback points with my system at around 3,300 and then 3,250. But we've got to get through that key technical level right there, which is where we got a lot of buyers sitting. And then if we come through that, you can see all these buyers sitting here right the dividing line between being in the green and being in the red for the year. Okay, a pullback down here is around 8% from the highs. I don't think we're going to go that far down. I think we'll probably find some softer correction around 3 to 5%. But that's when buyers are going to step in again. Okay. I do believe I can see this level here. If we do this dip over the next couple of weeks, then I can see us running up to 3650 area, over 3600, and then we're going to run into more trouble. Okay. Keep in mind, we got a couple of key events coming up. We get the September FOMC, I think on September 16th in the middle of the month. They're going to expand more on their change of policy, which did affect the markets to the upside. Okay. They're going to expand on it more. And that's going to have the tendency to affect the markets and price action and what they're willing to play for forward earnings, which is, they're willing to pay a lot more now with that elevated PE ratio. The 12-month forward is at 26.74. That's huge. But the other big event coming up, obviously, is silly season with the election. So for members, the first Sunday after Labor Day weekend, we got a big holiday coming up this coming next weekend. U.S. markets will be closed all day on Monday, so it'll be a short week. That following the Sunday after our Labor Day weekend, I'm going to spend time with our members going through longs and shorts, depending on the makeup of the Senate, Congress, and the White House after the election. So we're going to watch that very closely. But this is what I'm looking at right now in the markets, guys. You can see with this big move up right here like that, the MACD for all practical purposes has been flat. That just signifies more of a consolidation mode. Even though we've been going up right here, the market's longer term, it's just like there's no place else for money to go. So we're seeing it kind of float in here like this. At the sign of any kind of trouble or anything like that, you'll see the market's willing to just take it back a step, but it's not going to go very far. At the sign of a virus, remember, we've got 2 or 3 drugs out there now in stage 3 clinical trials on COVID here in the U.S., notwithstanding China and Russia's announcement that, hey, they've got it already solved. But they don't go through the FDA requirements like we do. They test it on people and then go live before it's even proved. But they don't really care about their people that much. At least the government doesn't. For them, it's all about a race. Here we got to get it through the FDA gates. But once it goes through there, in October, 3 companies are going to be coming out. And it's either going to be good or it's going to be bad, and all it takes is one of the 3 to show success. You're going to see the markets react very favorably. If it's negative, you're going to see the markets react very negatively to those news. So that's in October. And then the month after, we've got the elections. Okay, so you've got all of that mixed in there. We're going to see elevated volatility all the way through the elections. Okay, so just understand that's what we've got coming up in this crazy silliness, in this crazy market for 2020. Okay. Now, the other thing I wanted to show you guys here, let me switch over. I've got the special index that I've created on the FANG stocks because they're really holding the markets up dramatically. Okay. I mean, that's where it's at. You've got Microsoft, Facebook, Apple, Amazon, Google. I've added Netflix to this specialized index here, and you can see we're at 2020 highs, okay? All-time highs, actually. You can see just this huge move higher. You can see it setting up, not even for a divergence. So the money is just pouring into these stocks. Every fund manager, if they go through a quarter in and they're not holding one or all of these stocks, they get beat up. So what it does is a self-fulfilling prophecy where they want to come in and buy these stocks, and that's continuing to move them higher. And they're taking a huge weighting of the S&P to the tune of 23-24%. What we did see this week is some rotation into industrials and cyclicals and things like that, but the money is still going into tech. Now, if we look at the markets in general, I'll show you the Dow here, the Dow futures. You can see here, the Dow futures just poked its head above the closing price of 2019. So we're just barely in the green. We're still away from the all-time highs with Dow, but you can see it just poked its head. These are the Dow futures. And then, of course, if we look at the cash index of the Dow, it's the same thing. It just poked its head above the 2019 closing price. So now the only one bringing up the rear is the Russell. If we take a look at the Russell, let me just find it. Here's the Russell futures, but the Russell index is the same. You can see here, there's the 2019 close. There's the 2020 high. And if I blow it up a little bit, you can see here's the all-time highs. that were made in 2018. So the small cap, as measured by the Russell 2000, is really trailing big time. So we're not getting a lot of participation in the small and mid cap. I would love to see more of that. If we get a clean sweep of the Republicans in both the Senate and in the White House with Trump, then I think you're going to see the Russell play catch up very fast, and that's where you're going to want to play. For our members, I'll go through more detail on this in a couple of weeks. But that's a little bit about what I'm looking at. Let's look at emerging markets. If we look at emerging markets, we're still in the red for the year. Okay. There's the 2019 close, very close to the 2020 high. We're still in the red year to date for emerging markets. All right. Not very good. And if we look at the all world index, which is VEU, it's Vanguard's all world index, you can see here again, well below zero. There's the 2019 close, 2020 high. You can see the 2018 high. So we're nowhere near the all-time highs. It's more like the Russell. So really the only performers this year outside of China year to date is the US, with 3 of our 4 indexes in the green, with the NASDAQ up over 30%, really kicking butt. I mean, just amazing. If we come down here and look at the VIX, as I said, the VIX actually, you can see it moving up off these lows here. All right, look at this. We were down here at one point back on August the 11th. The VIX actually got to 23.6. But if you look at the past couple of weeks or a couple of days this week, though, we were up. And that just shows the sensitivity of volatility. And when volatility moves up during the week, when the week also moves up in a positive correlation manner, that's not a good sign. 90% of the time, volatility is going to win out. Okay, I've got some breadth charts that are suggesting we should be picking up more puts. So members, I'll go through this with you Sunday evening. But that's a little bit about what volatility is saying to us. If we look at the back month vol futures, which is August and September futures contract, let me see here. I don't think I have that set up correctly, so I'll have to redo that. If we come over here and we look at bonds, let's go over to bonds rather, and let's take a look at bonds. If we look at the bond market, well, we've broken this range here. Now remember, with the change in Fed policy, I think we're going to keep interest rates lower for longer until the bonds get fed up. So the tendency will be for the bonds to come down and test this 200 moving average right here, but it's going to stay low, which means bonds are going to stay elevated until inflation starts to show its ugly head here, if it does show. But the Feds are determined to get inflation running again. Okay, so we're going to see the bond market play this thing out. It's going to be really interesting, but there's been some good trades for us in the bond market. And same thing if we come down here and we take a look at the interest rates. If we look at the 10-year rates, you can see how they've slowly come up off these lows here, but we're still in this range bound. I don't think rates are going to go too high. I think rates may come up a little bit more, but then they're going to kind of run sideways. All right, that's a little bit about what I'm looking at for the rates. And let's look at the US dollar. Really an ugly week. You can see here, as I've been saying over and over again with the US dollar, any rally in the US dollar here should be sold off. Okay, there's still too much downside action in the dollar. Now, the best way to translate that into a trade would be in the euro. All right, that would be the easiest way to do it, because the euro is really about 57.6% of the dollar index, because it's really a dollar index. It's not just pure dollar. And if we look at the euro, it's going to be moving up. And as I said before, I told you guys last week, down in this area down here, you want to be a buyer of the dollar, right? Doing some bull put spreads or just some bear call spreads, bull call spreads rather. Everything is bullish here for the euro. And I think it'll come back up and take out that 2020 high over 119, okay, and move a little bit higher. If we look at gold, gold had a very strong Friday. It was up 40 points. You can see here where gold is testing this upslope and trend line. Remember, gold is a very technical trade. We're getting across in the MACD here, so this suggests gold is going to come up to my near-term target, sitting here around 2150. Okay, it's going to move up. It came right down. Look at how it's a technical trade, guys. It just sat right on the 38.2 fib node. All right, just sitting there. And we also found support in this upsloping trend line. Okay, this upsloping trend line comes all the way back to the down mode on March 23rd. All right, and then boom, away we went. You can see where it's finding support multiple occasions. And then it found support on that big downdraft here, and now it's finding support in this recent move here like this. If I just kind of widen it out for you, you guys can see it. This is the move right here, guys. I do believe that if it takes this out, moves up over 1991, then it's gonna jam through 2000, test this pivot high. It hits that pivot high, it's gonna run up to 2089. Okay. Again, my near-term target is sitting right around 2150 for gold. But I did not want to trade it in this area here. So if it breaks there, that would be a nice signal. But I still am not as big on gold as I am on silver. You want to play silver to the long side because on a percentage basis, it's going to outperform gold. And if you'll notice, it's found a support at the 236 fib node rather than lower down, and I think it's going to run up a little bit higher here. Okay, and if I were to just test it out and just kind of see where the target is here for silver, it's around 31.41. Okay, it's sitting at 27 now, so that's a nice little return. Silver, you're going to get a better return on capital in gold. I've been talking about that because of the silver gold ratio. It's just been running lower or higher than it should be, meaning it takes more ounces of silver to make 1 ounce of gold. It's coming back in line, but it's still elevated enough that it would favor silver over gold. Okay. If we look at the energy market with oil, oil has been flat for quite some time, but more in a grind up mode. It just slowly took out its 200 moving average, 200 EMA. It'll find support here, but I still think it's more prone to the upside than the downside, but just grinding, guys, grinding. If we look at nat gas, it's going to get a little bit ahead of itself. It gapped up here. I think it's going to hold that line, come back down a little bit, and then try and make another run. That second run is where we're going to want to short it. Okay, remember we had the hurricane blow through Louisiana and northeast Texas, so that had a tendency to shut some refineries down. So that's what caused a little bit of a gap here. I think it's going to rest a little bit, maybe pull back a little bit, then make another run, and then give it up. And that's where we're going to want to play it, okay, from that perspective. All right, everybody, that's just a quick and dirty of some of the key commodity markets, financial markets, and some of the major indexes here in the U.S. and globally. Members, I will see you this Sunday evening. If you're not a member, I highly encourage you to come in. We're kicking it pretty good this year like we did last year. And I think the end of the year is going to offer up some really great opportunities. Depending on who comes into the office, is going to change the nature of the opportunity, but members, I'll review that with you in a couple of weeks. Again, non-members, come on in, check us out. We're having a lot of fun. Have a great weekend, everybody. And members, I'll see you tomorrow evening for our weekly market watch. Take care, folks. Ciao now.